Welcome back to Smart Stock Sam, the channel where we cut through Wall Street noise and hand you the data that actually moves your portfolio. Today, we are diving deep into one of the most controversial, most shorted, and most talked about pure-play AI stocks on the NASDAQ right now, SoundHound AI, ticker symbol SOUN. By the time this video is over, you are going to understand exactly why this stock just cratered after beating revenue expectations, why Morgan Stanley is quietly loading up more shares even as the price falls, and whether the most explosive short squeeze setup of this summer is already being assembled right underneath your feet. Stay locked in, because this one is going to move fast. Let us set the stage. Imagine you run a company. You just reported record revenue. You crushed what Wall Street expected. Your year-over-year growth is running at over 50%. By every traditional measure, that is a victory lap quarter. Now imagine that the morning after you report those numbers, your stock drops more than 16% in a single trading session. That is exactly what just happened to SoundHound AI following their Q1 2026 earnings release. So the question that every investor needs to answer right now is simple. Was that sell-off a catastrophic warning signal, or was it the single best buying opportunity this stock has offered in months? And which side of that trade are you going to be on? Here is where things stand right now. SoundHound closed on May 15th at $8.41. On the surface, that number might not mean much to you, but when you layer in the moving averages, it tells you everything. The stock is currently suffocating below its 50-day simple moving average, which is a bearish signal. But at the same time, it is still clinging to life just above the 200-day simple moving average. In technical analysis, that is called a battleground scenario. The bulls and the bears are dug in at literally the same price level, fighting for dominance. And whichever side wins this war in the next few trading sessions is going to define where this stock goes for the rest of the quarter. Now let us talk about the actual numbers from Q1, because the headline revenue figure of $44.2 million only tells half the story. When you strip out the acquisition-related contributions and look purely at the organic core growth inside their automotive and IoT divisions, that segment grew by 88% year over year. 88%. That is not incremental improvement. That is a company that is aggressively taking market share in one of the fastest growing technology verticals on the planet. Automotive voice AI is not a niche anymore. It is becoming standard equipment, and SoundHound is positioning itself to be the default operating system for how your car talks back to you. But here is the metric that spooked the institutional traders and triggered that 16% flush. GAAP gross margins did not expand during this growth phase. They compressed. We went from 36.5% down to 31.1%. When a growth company is scaling this aggressively, you want to see margins improving as revenue rises. Instead, management is spending heavily on integration, development, and expansion. Their adjusted EBITDA loss widened to $26.7 million. Now, here is the critical question that separates the sophisticated investor from the emotional one. Is this the kind of spending that destroys long-term value? Or is this the kind of spending that buys you a dominant market position before your competitors even know the race has started? To answer that, you need to look at the 3 strategic moves that management is making right now, because these are not small bets. The first is what I am calling the acquisition pivot. SoundHound has signed a definitive agreement to acquire LivePerson, a major player in digital customer messaging and AI-driven communication. The second pillar is their Oasis platform, which is their agentic AI infrastructure that allows companies to deploy self-learning AI agents in minutes instead of months. Think about what that means for enterprise clients who have been paying consultants for months of integration work. SoundHound is trying to compress that timeline down to almost nothing. And the third pillar is their retail expansion, specifically through a partnership with Walmart to integrate their voice AI technology into the ONN television brand. When you combine automotive, enterprise agentic AI, and consumer electronics under one voice AI umbrella, you start to understand the size of the ecosystem they are trying to build. Now let us zero in on the LivePerson deal, because this is where the math either makes SoundHound one of the most undervalued AI companies on the market, or where it becomes a cautionary tale about overpromising and underdelivering. SoundHound is acquiring LivePerson at an implied enterprise value of $250 million. Their stated goal is to unlock a $500 million revenue opportunity by cross-selling their voice AI technology to LivePerson's massive existing enterprise customer base. LivePerson already has deeply embedded relationships with major enterprise clients across retail, financial services, and telecommunications. Those are exactly the verticals where SoundHound's agentic voice AI has the highest potential commercial value. If they successfully execute that cross-sell, management has already projected 2027 revenue to land somewhere between $350 million and $400 million. Let me put that in context. We are talking about a company that just reported $44 million in a single quarter, being guided toward nearly $100 million per quarter within 18 months. Does that sound like a company in trouble, or does that sound like a company that is making very large, very deliberate bets on its own future? And here is the deeper question worth sitting with. What does SoundHound look like at $400 million in annual revenue if margin compression finally reverses and gross margins climb back toward 50%? Here is where the smart money comes into focus. Despite all of the post-earnings volatility, despite the margin compression narrative, despite the 16% single-day drop, institutions now own nearly 55% of the float. We are talking about 472 separate institutional owners, and yes, 235 of them recently decreased their positions, but 233 of them increased their positions at the same time. That is nearly a dead split. Now here is the number that should make you pause. Morgan Stanley increased their position by 48.1%. UBS Group increased their stake by 37.2%. When two of the most sophisticated capital allocators on the planet are adding nearly 50% more shares during a period of price weakness, that is not panic. That is conviction. They are not trading the quarter. They are investing in the thesis, and their thesis has a 2027 target date. But before we get too bullish, there is a piece of this story that you absolutely cannot ignore. And honestly, it is the part that keeps me up at night when I look at this chart. Over the last 6 months, there have been 18 insider sales and 0 insider purchases. Not one. The CEO, Kivan Mahajer, personally sold over 268,000 shares for approximately $2,470,000. Now, insider selling alone is not always a red flag. Executives sell for all kinds of reasons: taxes, diversification, planned liquidations. But here is the date you need to write down right now: June 16, 2026. New trading plans were quietly adopted back in March that are going to allow company executives to sell up to 2.4 million shares each, starting on that specific date. When insiders are clearing the runway for massive potential liquidations while the stock is already struggling to hold key technical support, the logical question is, what information is baked into their decision-making that has not yet appeared in a public filing? Now let us bring in the technical picture for the week of May 18th through 22nd, because if you are planning to trade this, you need to know exactly where the lines are drawn. The 14-day RSI is sitting at 50.18. That is the textbook definition of no man's land. We are not oversold, which would signal a bounce. We are not overbought, which would signal a top. The MACD just crossed into negative territory and issued a fresh sell signal. The stock is trading below both its 5-day and its 50-day moving averages. Every short-term momentum indicator is pointed in the same bearish direction. On the daily chart, almost every near-term indicator is flashing caution or outright bearish. But there is one signal that is keeping the entire bullish thesis alive. and that is the 200-day moving average sitting at $8.03. That level is the last line of defense. It is the only buy signal left on the chart, and it represents massive psychological support for every long-term holder still in this position. Lose that level, and the technical structure of this stock changes completely. When we zoom into the price action, the setup becomes incredibly precise. To the upside, the stock needs to reclaim $8.55 and then $8.63 to signal any kind of real recovery momentum. Those are the levels that would tell you the post-earnings flush was just a temporary reset. To the downside, we have immediate support at $8.38 and $8.28. But everything pivots at $8.03. That is the number. If SoundHound breaks below $8.03 on meaningful volume, the risk of institutional stop losses triggering a cascading sell-off becomes very real, and the next support zone does not appear until the $6 range. That would be a brutal drawdown from current levels, but here is the wild card that could flip this entire script in 48 hours. Do you want to know what keeps short sellers awake at night? 40.78% of the float is currently being shorted. That is a record high. We are talking about over 157 million shares held short right now, and here is what makes that number explosive. The borrow fee rates for shorting this stock are running between 26 and 36% annualized. It is becoming genuinely expensive to maintain a short position in SoundHound. The days-to-cover ratio, which measures how many days of average trading volume it would take for all shorts to buy back their shares, is sitting at up to 6.7 days. 6.7 days. If a single meaningful catalyst drops, a new enterprise deal, a partnership announcement, a rumor about the LivePerson integration, the shorts are going to be fighting each other to cover, and every dollar they buy sends this stock higher, which forces even more short covering, which sends it even higher. The retail sentiment score is sitting at a bullish 72 out of 100, driven almost entirely by anticipation of exactly this scenario. And if you think that is just retail speculation, look at what the options market is telling you. The put-to-call volume ratio on SoundHound right now is 0.21. That means for every one put option being purchased, there are 5 call options being bought. Traders are aggressively targeting the $9 and $10 strike prices for the May 22nd expiration. There are nearly 10,000 contracts sitting at the $9 strike alone. When you see that level of call concentration, the market is not hoping for a bounce. It is pricing one in. The $8 strike carries the highest put open interest, which tells you that the options market has collectively decided that $8 is the floor worth defending. Professional traders have drawn that line. So where does this all lead? The bearish case targets a retest of $8.03, the 200-day average. If that breaks, we are looking at a trip toward the $6 range before any structural support kicks in. The bullish case has the stock recovering to $9.18, the break-even point for all those $9 calls, and potentially toward $9.61 if momentum builds. Zoom out even further to the analyst community, and despite D.A. Davidson and Northland recently trimming their price targets, both firms still have $12 targets on this stock. The median 12-month consensus price among all covering analysts is $14.50. We are sitting at $8.41 right now. You do the math. For those of you building a tactical trade plan for this week, here is the setup. The entry zone sits between $8.28 and $8.40, right at current support. The stop loss is non-negotiable at $7.95. If that $8 floor breaks, you exit. No arguments, no averaging down. The risk per share is approximately 40 cents. The primary target is $9 even, where call interest is concentrated. The secondary target is $9.61. That gives you a risk-to-reward ratio of roughly 1 to 3. You are risking 40 cents to potentially make $1.20 or more, but only if the setup holds, and only if you honor the stop. The bottom line on SoundHound AI is this. The battleground is set at $8.03, and everything you need to watch this week comes down to what happens at that level. A successful defense of the 200-day moving average does not just mean a small bounce. It potentially lights the fuse on a 40% short interest powder keg that could send this stock screaming back toward double digits. A break below $8, however, especially heading into that June 16th insider unlock date, puts significantly more downside on the table. Watch the volume at the $8 level. If the smart money shows up to defend it, SoundHound could become the AI comeback story of the summer. If they do not, June 16th is going to be a very long day for every shareholder on the books. Before we wrap up, I want to be completely transparent with you. Everything discussed in this video is for informational and educational purposes only. Nothing here constitutes financial advice, investment advice, or a recommendation to buy or sell any security. I am not a licensed financial advisor. All investing involves risk, including the potential loss of principal. Always do your own research and consider consulting a qualified financial professional before making any investment decisions. Past performance of any stock is never a guarantee of future results. Now here is my question for you, and I genuinely want to know what you think. If SoundHound successfully integrates LivePerson and hits that $350 million revenue target by 2027, does the current price make this one of the most undervalued AI stocks on the market? Drop your answer in the comments below. I read every single one, and I reply to as many as I can. If this breakdown gave you clarity or helped you see something in this chart you had not noticed before, smash that like button because it genuinely helps more investors find this content. And if you are new here, hit subscribe so you never miss a breakdown like this. We publish fresh analysis every week on the stocks that matter most. And if you want to go one step further and directly support the work we do here at Smart Stock Sam, YouTube has a super thanks feature. Every contribution helps us keep this research independent, unsponsored, and entirely focused on giving you the edge. I will see you in the next one. Stay disciplined, stay data-driven. I will see you in next update.